Hi guys! On the previous model you've learned the basics of the management balance sheet. If you keep checking your balance sheet, you always be sure about your final financial result. Now, imagine that a company has been working for several months in a row, but there is no gain in capital. Its equity is not growing at all. And what might be the particular reason for that? Maybe this company does not sell enough. Maybe just below the break-even point. Maybe they sell quite a lot, but with low margin rate. Or maybe they generate huge margins, but the operating expenses eat them all. Maybe the assets just lost in value because of the market drop. High interest rates, large taxes. Maybe this company generates a good net profit, but the owners getting really nice dividends. That might be plenty of reasons, and you have no idea which one, just looking only at the balance sheet. To understand the net profit wise, you need the other financial report, the income statement. Income of what? The income of equity? Just to remind you, the net profit is not an increase of cash, it's the equity gain. Actually, there are two more financial statements, income statement and cash flow. And don't confuse them, guys. The income shows how we earn in profits. The cash flow shows how we spend in cash. With both these statements alongside, you control how your profits converting into cash. Based on different principles. Income statement based on economic sense, when we would love to know how our sales would supposed to be distributed in a most reasonable way. Cash flow is guided by actual payments, and that's it. Let's go through main differences. There are four main principles, and ignoring them often leads to most common mistakes. The first one is the recognition principle. Income statement based on accrual basis, so focused more on when we create value than just moving cash. When you did your service and your client accepted it, that might be they haven't paid you yet, but you still earn it. And they owe you in your balance sheet anyway. They call it accrual principle. The accrual principle is important for revenues and expenses as well. Let's say we stop paying for our services, but still consuming them. It doesn't mean we're creating profit now, because we're creating liabilities. To simplify that income statement based on confirmed invoices, when cash flow on payments receipts. The next principle relates to direct material costs. When you provide services, consume some raw materials, or just selling goods, in your income state expenses you should reflect cost of goods sold, but not cost of goods bought. That is important when in the same period you bought one parts but didn't use all of them. For example, if we bought some funny stationery from any Chinese providers for 100k to sell it through Amazon marketplace, but half of them, 50k, it still remained in stock in the balance sheet, then our cost of goods sold, the other 50k, goes to the income statement. So we calculate our margin profits for goods we sold, but not for goods we just bought and haven't sold it yet. At the same time, in your cash flow statements, you should reflect all the cash you paid to your vendors. The third principle relates to capital expenditures. When we buy new equipment or vehicles, in income statement we reflect only assets depreciation but not invested cash. And depreciation here is the assets lost value. If you bought a new Mercedes-Benz at 50k, but it's still worth of 40, that means that your loss of equity or depreciation is just 10k. All money you spent on the car you reflect only in the cash flow statement. It's vital to estimate your depreciation based on your management plan. We mean here its actual losing value rate. In some countries with huge inflation rate, people might have objections about it. If I bought my car like 2 years ago, but now I can sell it even higher, what is the purpose of depreciation in my case? The answer is, you might sell it higher, but you can't buy a new one at the same price. Later you might learn how to do this estimation and manage your investment funds. And the fourth principle relates to financing. If you finance your business using the borrowings, In the income statement, you reflect only interests, but not all principal. Your loss is only interest expense because you're gonna pay them from your profit, but not from money received. In the cash flow statement, you reflect all your credit, receivings, payments, everything. Let's say if we total pay to banks 20k, but they decrease our amount of debt only by 18. That means 2k is our interest expenses and it goes right to the income statement. That is just basics of income and cash flow statements that might confirm any accountant. What makes these statements really special for management? Nice one. These statements together show exactly how the company's net profit was generated from sales and then converted into free cash. That means how the company's profit funnel works. Profit funnel is like the sales funnel, right? If a sales funnel represents the conversion of potential customers into actual clients, a profit funnel is transformation of sales into net profit for owners. Sales funnel is a really great tool, but it's just half of the story from the owner's point of view. Please don't forget about second part of the journey of money from clients to owners. Not every dollar received from a customer reaches an owner. Many of them just burnt out in logistics, production or marketing ovens. There are always some holes in this funnel and it needs to be properly managed. The management income and cash flow statements can be structured according to the way how the company's profit funnel works. The most easy and funny way to describe this financial funnel is the salmon model. It stands for sales, margin, operating, net profit. Here you can see the 4 stages of the net profit transformed from sales. The starting point is sales. Then we measure the part of sales that is left after costs directly attached to products or services. We often address it as margin or gross profit. After that, we measure the operating profit, which is part of margin that is left from other operating expenses exactly by functions like production, logistics and marketing. This part of profit we call operating profit. And finally, the net profit, which is the part of operating profit free from financial expenses like taxes and interest, and this part of the profit goes right for owner's disposal. Why only the tail of fish remained for owners here? That is often the case because of poor budgeting. Now guys, speaking seriously, there are the 3 ideas about how to make the income and cash flow statements most manageable. First, always look at these 2 statements together, otherwise this financial anxiety will never let you go. If you see only income, you keep wondering, where is your money then? If you look only at your cash, you're so curious what part of it is your net profit. Secondly, the salmon model or not, always prepare these 2 statements using the same frame of a profit funnel. If you look at your income statement prepared in one way and then at your cash flow structured differently, you're gonna be really frustrated. Finally, the best way to break down the statement expenses is based on your organizational structure. For example, if your company organized like production, marketing department, logistics, administrations, it makes sense to structure your financial management statements exactly the same way. Now guys, let's stop my talking for now, because the best way to get these financial statements is to practice them, right? And how do you feel of doing some practice now? Great, let's do it together.